Good morning, guys, and welcome back to another video. This is Long Forex Academy. Sorry, I haven't posted in a while. I've been actually working on what you can see here, getting the home office ready for work. So, guys, today's video is going to be a little bit different. It's not just going to be talking. We are going to also mix it up with the chart work. I think I will make a video after this on how I actually analyze the market. You can see it on my screen already. So before I start the video, guys, I want you to excuse me, pardon me for maybe the noise you get at the background. Today is Sunday. I live in a very noisy environment, and I'm equally home with my daughter. You may hear her from time to time making some noise in the background, so pardon me for that. So guys, let's dive in straight into the video. So today's video is about the best time frame to trade. Which time frame should you be trading? And I don't want to make this video very lengthy. I realize over the past videos that the videos are very lengthy. I want us to talk a bit about best time frame to trade. Now, I'm not here to tell you exactly what you should be doing. I'm here to tell you what works. I've been doing this for 5 years. I think I've seen a lot of setup. I've seen a lot of market patterns. I've seen a lot of things repeating itself in the market. So I think I'm in a better position to tell you exactly what I have experienced in this market. So when we talk about the best time frame to trade, there are different time. There are so many time frames ranging from 1 minute right up the way to 6 years, even depending on the platform you are using to do your analysis. And in my own opinion, from what I've seen all of the past years, I've discovered that there are a couple of things you should consider before you decide on which time frame you should actually be trading. So the first thing you should actually be considering is managing risk. You understand risk management. Risk management. Now, how does risk management come into play with which time frame you should be trading? Imagine you are trading a time frame. Those of you who are scalpers, for instance, or day traders, like you say, trading lower time frames. Okay, the smaller the time frame you trade, the more you have to trade. Okay, that's like if you're trading 15 minutes, 30 minutes, you may find setups within the day. You may find so many setups within the week. Now, it makes you to overtrade. It causes you to overtrade because each time you open up a lower time frame, you must definitely see a setup you want to trade or a pattern you want to trade. It causes you to overtrade. It causes you to over risk. Definitely, overtrading is over risking. And our primary job in this market is to manage risk and the results will follow. So, I think managing risk is supposed to be the first parameter you should consider before choosing what time frame to be trading on. Personally, I trade from the monthly right down to the 4 hours. In some very rare instances, I may go down to the 2 hours because I use 2 hours, 4 hours, and even daily at times for my entries. Some people will say those are bigger time frames. The risk is more, but what do you think? What do you prefer? Is it better to get stopped out many times or just risk more and stay in the trade and benefit as much as you can? So, guys, risk management, okay? The over trading, lower time frames, over trading. So avoid these lower time frames because you to find pattern which repeat himself so many times and you don't really know which one to choose. You don't really know which one is the best among them. Okay. So second is getting stopped out. Getting stopped out. Okay. These lower time frames cause you to get stopped out so prematurely. Let me take for instance. Let's say you are buying at a particular support area. Okay, you set your stop loss below the support area, assuming people expecting the market to buy and push up. Right now, the market may simply form a big bearish candle. Okay, and then hit your stop loss below before going in your direction. But if you zoom out now and go to a bigger time frame, say the 4 hour time frame, you realize that market that just stopped you out is maybe simply reacting to a particular area. Maybe your spot was not well drawn on those lower time frames. If you had done the drawing on the higher time frame, probably you will still be in the trade and the stop loss will have just been a stop loss hunt and your stop loss will have been well placed. So these lower time frames equally cause you to get stopped out so frequently, so prematurely, and it can be very annoying and psychologically defeating. So you need to avoid these lower time frames as much as you can. At least in my opinion, in my experience, lower time frame cause you to get stopped out so prematurely before the trade even take off. Okay, so second, getting stopped out prematurely. The third will be news effect. So before you choose which time frame you should be trading, also consider news effect. Right now, how do I mean? Most of these lower time frames, okay, anything below, I consider anything below the 2 hours, 4 hours, anything below the 4 hours, I consider it to be a lower time frame. Now, high impact news events such as the FOMC, CPI, NFP, This news event causes a lot of volatility in the market, and it makes it such that if your stop loss is not properly placed and you are trading with lower time frames, the market simply wicks down above your stop loss or below your stop loss and then gets you out and then continues in whatever direction it wants to continue. Whereas if you're trading these bigger time frames like I do, the 4 hour and the daily for entries, what happens probably is that you will most probably not even feel the impact of that of such news. It is very difficult for the kind of pairs too you trade. Okay, well, I will make another video on the kind of the pairs I trade. On the kind of pairs you trade, if you are trading major currency pairs, for instance, the euro, the GBP USD, AUD USD, gold, it is very difficult, okay, for news to get you out of the market if you are trading the bigger time frames because your stop loss is placed at a reasonable distance away from whatever manipulation may be happening in the market or whatever area the news can actually get. If you're trading the lower time frames, it gives you the illusion that you can just place your stop loss anywhere below or above, and then a small news spike just get you out of the way. Okay, so news event, the next will be timing. Okay, timing, because when you trade these lower time frames, okay, what happens is that you need to be perfect with your timing. You cannot afford to miss. Let's say you are waiting for 15 minutes candles close for your entries. At maybe 8:45, you're at maybe 8:30, you're monitoring the entry. You want to get it and the close of the 8:30 candle, opening 8:45 candle. At the opening of the 8:45 candle, you don't have to come at 8:47, 2 minutes after, 1 minute after, because the market will have taken off without you. And ask yourself, what is the need to be a trader? You say you want to be a trader who wants to be financially free, time free, and whatever not. And you are so much focused on the chart, you are so much on the chart, you devote yourself to the chart, you become a slave in front of the chart because you want to get the perfect entries. Whereas you could just go higher to a bigger time frame and then you spot your entries. You don't need to be perfect, you just need to wait for a 4 hour candle close. If we are maybe at 12 p.m., 12 p.m. in the afternoon and you want to get in at the next 4 hour candle close, probably you don't need to come back at 4 p.m. At least you have 4 hours to prepare yourself. It is better, it is more satisfying, it is more relaxing. Okay, so you need to be very perfect in your trading lower time frame, and it's not really easy. People stress a lot with perfection, with perfecting their entries, which is not even the most important thing in this business. If you have watched my previous videos, you have seen videos that I've talked about psychology. It's the most paramount thing in this game, guys. We'll talk about this in another video. And then the last thing I want to talk about on what time frame you should be considering trading is limited amount of tips. Limited amount of tips. You cannot be trading 15 minutes, and this is why most of you lost money. You find the market go to your direction reasonably and reverses back down to your entry or even probably your stop loss. Now, when you trade these lower time frames, okay, you cannot be trading 50 minutes time frame and hoping to catch 200 pips, 300 pips. That is great, and that is so impossible. I mean, you want to catch 200 pips, that how much pips are you even risking? How can you be risking 30 pips to make 200, 250? It may happen once in a while, but how many times in about 100, 200 trades? This thing is all about collecting your statistics and your data. You cannot just have a lucky 200 pip win by risking 215 pips, and you are so comfortable call yourself a pro. No, 15 minutes, 30 minutes, these lower time frames, the less risk you take on these lower time frames, the less profit you are also bound to make. Because if you take a trade on the 4 hour, risking maybe 100 pips or 200 pips, then you can catch 400 pips. That's maybe 1:4, 1:3. It's very possible, but you cannot be risking 15, 10 pips on a lower time frame to catch 200. We are going for about 1:20, 1:10. How possible is that in a large sample of trades? It's not very possible. It may happen from time to time, and then it's purely luck. Okay, so the lesser the time frame you trade, you should not equally be hoping to catch so much tips. Okay, I will make another video on the shocking truth about the risk to the world, because this thing is making a lot of people to fall into problems. Okay, that's why I said this thing at the end of the day is all about experience and the number of hard work and hours you have put in. Right, because most people just think you have a strategy that gives you 1:3, it means it's going to work 100% of the time. You just think that 100% of the time you are going to be having your 1:3 risk to reward target hit all the time. But when the market gets to 1:2, it reverses. Ask yourself, this number of times the market is getting to 1:2 and reversing. What if I had just set my take profit at 1:2? Won't I avoid this getting stopped out and so on? So, like I said, I don't want to make this video very lengthy. Okay, so just a recap on what we have said today. Before you consider what time frame you should be trading, consider first that you have to manage risk. Consider also that you have to analyze your trades so that you don't easily get stopped out on lower time frames. Also consider news effects, how they may affect your stop loss target. Consider that you need to be perfect with your timing and your entries, which is not always easy. And lastly, the lesser the time frame you trade, the lesser the amount of pips you're hoping to catch. Okay, so I hope you got one or two things from this video. Please help us support the channel. It's really not easy assembling these videos together. Please help us support the channel, grow the channel with us. Hit the like button, hit the subscribe button, share the video with your friends. And if there are any comments or questions or anything you want us to talk about and make a video on, make sure you drop that in the comment section, and I will do my best to get back to you guys. Okay, so thank you very much and see you in the next video.